When a company uses a predetermined overhead rate to assign costs to jobs, it's unlikely the amount of overhead that's been allocated or assigned to work in process will equal the actual amount of overhead we incurred during a period. We're going to go ahead and calculate the amount of under or over applied overhead and show how we would close out that under or over applied overhead to cost of goods sold at the end of the period. Again, if a company applies overhead using a predetermined overhead rate, it's unlikely that the actual overhead will equal the applied overhead. We have underapplied overhead if the amount of overhead that we apply to a job during a period is less than the total actual overhead incurred during the period. On the other hand, we have overapplied overhead if the amount that we apply to jobs is greater than the actual amount of overhead we incurred during a period. Let's go ahead and take a look at some numbers or an example of some numbers to get a better idea of what we're talking about. Let's look at the parent company. We're told that the parent company's actual overhead for the year was $650,000 with a total of 170,000 direct labor hours worked on jobs. And we're going to want to calculate how much overhead was applied to the jobs and how much over or under applied overhead we have. We're told that the parent company's predetermined overhead rate is $4 per direct labor hour. So the amount of applied overhead will be the $4 per direct labor hour multiplied by the 170,000 direct labor hours. We will apply $680,000 in overhead to jobs during the period. Since this is less than the $650,000 in actual overhead, parent company has overapplied overhead, where it's applied too much costs to work in process. And since work in process is too high by $30,000, as we transfer our cost to finished goods, our finished goods will likely be too high by $30,000. And as we move finished goods cost to cost of goods sold, our cost of goods sold also will be too high by $30,000. Let's look at the T account for manufacturing overhead. Again, our actual overhead is recorded on the left-hand side with a debit, and we apply overhead on the right-hand side with credits. And we can see at the end of the period, we have a credit balance of $30,000. Our journal entry then to close out this manufacturing overhead will involve a debit to manufacturing overhead and a credit to cost of goods sold. And this is exactly what we want to do to cost of goods sold, because we said work in process was too high by 30, which meant finished goods was too high by 30, which meant cost of goods sold was too high by $30,000. So our journal entry of a debit to manufacturing overhead of $30,000 and a credit to cost of goods sold will both zero out manufacturing overhead and properly state our cost of goods sold balance.